Hi friends, good to have you here. Get your pad and your pen and let's get started. So today we'll talk about some basic terms that are very important for you to understand. And right off from here, you see that I'm pulling definitions off the dictionary. This is because what you want to understand are basic terms, things that you things that you normally would would use in your daily interaction. So let's define what trading is from the dictionary. So it says trading is the buying, the business of buying and selling or bartering commodities. So bartering commodities is the exchange of two commodities for themselves. So I have a piece of I have a piece of gold and you have some yam. Gold today is considered a form of currency, but ideally it's just a commodity, it's a metal. So a worthy example would be exchanging yam for fish, exchanging cassava for, you could even exchange a commodity for a service. All right. So you can exchange your cassava for a bricklayer service or a goldsmith service or something. So that's what trading is. It's basically a form of exchange. Here, according to dictionaries, the business of buying and selling or bartering commodities. Another definition is to give one thing in exchange for another. So one thing, so that means it's not tied to commodities alone. It could be products, of course. It could be services as well. It could be intellectual. It could be something intellectual. You could go to the village priest, or to the herbalist or something like that, and you need some medical care or some spiritual assistance. And before the days of cowries and before the days of money, before the days money was a thing, you would have to exchange what you had. And the farmer gave what he had was corn, the fisherman gave what he had, the people of the people who had services gave their services. So let's carry on. It is also it also means to engage in the exchange, purchase, or sale of goods and services. So yeah, just that's what trading is. The exchange, basically trading is the exchange of something for another. Simultaneously, in the act of trading, two things must occur. There must be a giving and there must be a taking because there's an exchange. There must be a buying or a selling. So let's define what the market is. So the market is a meeting place. So it's a meeting together of people for the purpose of trade. So a market is a place where what we just described earlier happens. So any place, any organized place where what we just described earlier happens. So any organized place where trading happens is what's called a market. So a market can also be an idea. So it can be the act or an instance of buying and selling. So basically, if you perform an exchange in your house or at the one of the exchanges location, that's where the market is, because that's where the exchange happens. So a market can also be an opportunity for buying and selling. So a large group of potential buyers or sellers can also be termed as a market. So you want to start a new business, you go into a country and you're doing your analysis, you're doing your feasibility studies, and you ask, what's the market like? So already you are anticipating the potential buying or selling power of that group of people, of the population. So that can also be defined as a market. So an opportunity for buying or selling. So from this, let's define what Forex means. So Forex, okay, it's derived from two words. So Forex is short for foreign and exchange, as you can see, FOR from foreign and EX from exchange. So Forex or foreign exchange is where banks, businesses, governments, investors, and individuals buy or sell currencies. So it is foreign exchange. Because we're dealing with foreign exchange now, it's predominantly currencies. So basically, everything we just described earlier, trading, market, Forex. So uh, trading and market of currencies. So trading of currencies, this currency for that currency, anywhere it occurs is the market. And if it is currency that we're exchanging, that is called Forex. So basically that's what it is. So Forex is where banks, businesses, governments, investors, and individuals buy or sell currencies. The global electronic marketplace for trading international currencies and currency derivatives. Later on, we'll understand what a derivative means. So Forex is a combination of foreign and exchange, is where bank, businesses, governments, investors, and individuals buy or sell currencies. Whenever you purchase something in another currency or exchange cash to get the local currency of another country, you're taking part in the foreign exchange market. So it could be as interesting as your trips, when you're traveling abroad. Even when you pay for services that are provided by companies that are not localized in your country, you pay for Spotify, you pay for Netflix, you pay for YouTube. That's Forex. That's actually Forex happening. So even if they are charging you in Naira, the fact that once it gets credited to them, they don't need Naira for anything. YouTube doesn't need Naira for anything. Canva doesn't need Naira for anything. So once it gets credited to them, there's going to be a form of exchange. So that's Forex happening, any form of exchange of one currency to another. So businesses and individuals often do this while investors trade currencies to profit from fluctuating exchange prices. So yes, we can expect that large conglomerate businesses that operate across several countries predominantly engage in foreign exchange markets, not for profits. However, they may receive some profits sometimes, occasionally, in some rare scenarios. For instance, if they have exchanged currencies to purchase goods in another country, you exchange your local currency, say the naira, you exchange it to the USD, and you want to purchase some goods in in another country because the US dollar is the standard currency. Now, in this case, let's assume that the naira got extremely devalued in this period, say 6 months, a year, and you still hold cash, you still hold you still hold value in the exchange currency. In this case, you have profited something called a windfall. So a windfall is when you exchange to a certain currency. You didn't exactly exchange to make profits, but when you're exchanging back to your currency because of the devaluation in your currency, you don't have so much. Basically, that's still what the intention of investors and traders are. But this can happen even without the intention. But as you can see here, investors trade currencies to profit from fluctuating exchange prices. So in turn, we're investors. Um, anybody would trade. Traders are also investors, because even the difference is that a trader is a very, very, very short-term investor because what you do is you put your money in something that you assume to have value, even if it's a currency. You assume that this currency has value and its value will increase within the next 2 hours, 3 hours. So because it's anything shorter than anything shorter than 3 months is predominantly considered trading. Longer than that, we have short-term investing, long-term investing, position investing. So Forex is the largest and most liquid market in the world. Participants in this global electronic marketplace trade about 7.5 trillion dollars per day in 2022, far exceeding the daily trading volumes of the world stock markets. The trading volume of the world stock market is certainly in the trillions too, but nowhere near what the foreign exchange volume is. So what this means is that each and every day, at least $7.5 trillion would be exchanged somehow. This does not mean $7.5 trillion in profits is being made. This does not mean $7.5 trillion in goods is being purchased or in services is being sold or being given. No, it means that there is, and in fact, this is what is captured. This is the amount that is traceable or trackable. So it means that at least $7.5 trillion has been exchanged amongst banks. Banks do a lot of transactions for large businesses, conglomerates. Even they themselves are buying into countries that they think would have value. Sometimes people are exchanging currencies because they want to buy the bonds of the country that they want to buy the bonds of the country that they are exchanging its currency to for so many reasons. There's so many reasons why people want to exchange currencies. This also includes people that are traveling. You're traveling, you're going from France, you're going to Australia. I mean, you're not spending euro in Australia, so you're going to exchange your euro for AUD. You're going from New Zealand to Japan, or you're going from Brazil to Kuala Lumpur. You will have to do a form of exchange. All of these exchanges is what's being considered in this $7.5 trillion every day. So you see, this is not all for profit. This is just exchanges that happen uh, because of the nature of the different currencies that exist in the world today. So yeah, still on Forex. So online Forex trading is an over-the-counter market. There is no single centralized exchange like there is with stocks. So if you consider the definition I just gave or the explanation I just gave prior, you realize that, the person going from Brasilia to Kuala Lumpur, where they would exchange that currency is different from where the person going from Auckland to Tokyo is going. You understand? And the person going from Paris to, maybe Melbourne or something where they would exchange these currencies completely different. So there is no one place where you have to exchange currencies. How GT Bank is exchanging its currencies to USD, maybe they are using JP Morgan or Chase or something. How the exchange in the forex market happens is not centralized. It's not one authority that is controlling it. There's so many ways you can exchange. In Nigeria, we have something called the Bureau de Change. You have they call them the BDCs, so individual registered but individual money exchangers. They hold a lot of foreign currency and you give them the local currency and they exchange it for you. So, and you have hundreds of them in a single location. So there is no centralized exchange. Where conglomerates will exchange their money is different from where a bank would, it's different from where an investor would, it's different from where a retail trader, it's just so many. So there is no centralized exchange for Forex. Unlike stocks now. Stocks usually have a centralized exchange for the stock market exchange in that country. So regardless of how you want to buy a Apple stock, you're still going through the New York Stock Exchange. Regardless of whether you buy from Robinhood or whether you buy from, regardless of how you buy, whether it's from a third party, a fintech app, whether it's from the bank, you are still going. Your orders are still going to pass through the New York Stock Exchange, and it's going to be recorded in the New York Stock Exchange. The New York Stock Exchange will have a record of that transaction and the New York Stock Exchange is going to facilitate that transaction. So we have the London Stock, we have the stock exchange everywhere in the world. London Stock Exchange, we have the NGX, the Nigerian Stock Exchange, New York Stock Exchange. We have it everywhere. So this is for stocks and companies, and this is the difference with trading stocks and with trading forex. There is no centralized exchange. There is multiple ways you can exchange. So transaction made over computer networks that connects these transactions are made over computer networks that connect traders all over the world. So currencies move among traders, often with the support of a broker. We'll explore what a broker is shortly. So since it is done electronically, there is typically no physical exchange of actual currencies. The main markets are open 24 hours a day, 5 days a week. So um, typically, physical exchange is not necessary, and this is because we're doing online forex trading. That's electronic forex trading, which is what most people are into today, and which is what we are talking about here, not the physical exchange. However, everyone still participates in the physical exchange somehow, especially when you have to travel. So the markets are open 24 hours a day, 5 days a week. So market opens 10 p.m. GMT plus one. That's UTC plus one, and closes 10 p.m. UTC plus one, and that's when there's daylight savings. All the timing will be explained shortly as well. So yes, 24 hours a day, 5 days a week. So think about it like this, because the foreign exchange market operates on the hours of large financial institutions. So just think about your average bank. Just think about your average bank or stock brokerage company, investment bank or something, and just think about the time of operation that they have. You understand? So the forex market also operates like that. The market operates like a financial institution. I think that's the point. It operates like a financial institution. Financial institutions are open during weekdays. Um, Monday to Friday. The only difference is that they are not open 24 hours Monday to Friday. So, however, the time of operation of these financial institutions seriously affects the liquidity and volatility in the forex market, which I would explain going forward. So, but just remember the online foreign exchange market operates like a financial institution. It's open 5 days a week, and it's open 24 hours, 5 days a week. However, there are specific time during these 24 hours that trading really is relevant. So Forex is the largest financial market, operating 24 hours a day during weekdays across major financial centers. Currencies are traded in pairs with pricing influenced by various economic factors. So currencies are, because there has to be an exchange. If there's going to be an exchange of something, there is what is being given and what is being taken. So that's a pair. So the farmer that is giving his cassava for corn, the pair of exchange is corn and cassava. So when if there was a dispute and they went to the village chief, the village chief is going to ask, okay, what is being exchanged? So it's corn and cassava, so that's the pair. So what pair? What in this case you can ask, what's the pair that you're exchanging? So what's happening? What's the two commodities being exchanged? So corn and cassava in this case. So coins that are exchanging pair. The person going from Brazil to Malaysia is going to be the Brazilian currency and the Malaysian currency, which is ringgit, I think. So same thing, New Zealand and Japan has New Zealand dollar, the Japanese yen. So that's what a pair is. The pair is the two values. Now, in this case, it could be currency, it could be commodities, it could be services. The two values that are being exchanged is what a pair is. So different types of forex trades. There are different types of forex trade. There's a spot, there's a forward, and there's a future. So the spot is this one is facilitated by something called CFD, which is contracts for difference. So basically, the spot is basically trading on the spot. This is what happens on most brokers, most CFD brokers. When you execute a trade, it is instantly passed to the liquidity provider and executed on your behalf. A forward is a forward is basically you anticipating the price of this usually happens in options, anticipating the price of a commodity and expecting a certain price, expecting to reach a certain price. So options are a little bit tricky. So futures contract is an obligation to do something. So you this is the best example. You want to buy cassava. You want to buy 10,000 units of cassava. Cassava keeps coming because it's a very common commodity. If you want to buy 10,000 units of cassava, one unit today is maybe $10, and you want to buy 10,000, 1,000 units, and you don't plan to buy everything now. You plan to buy it over the next 6 months. And go to the farmer and you tell him, look, I am guessing the price of cassava is going to increase to $15 soon. So one is currently $10. So I'm guessing the price will increase to $15 soon. Now, here's what we're going to do. Let me lock in the price. Let me lock in the 1,000 I'm about to buy. I cannot purchase all of it now. I'll just purchase 100 now and come and pick 500 later. So you say, let me lock in the price at 12. So even if in the next 6 months the price gets to 15, you will still sell it to me at 12. So that's a futures contract. So the exchanges that facilitate this, they know how they go about it. It's all electronically done now. So yeah, that's what a future contract is. So now in the case where the price actually does go to $15, the 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 buyer is basically making a profit in this sense. And this is like a $3 profit because you are actually buying at a market discount. Now you can basically take that commodity and go and sell it at the current market price. But if it doesn't and it remains at 10, the buyer is going to be losing $2 on every transaction because you have agreed at a certain price into the future with the seller of the commodity. So trading forex involves choosing a broker. You need to understand leverage and you need to execute trades. So forex trading carries risk such as leverage and market volatility, but it also offers liquidity and flexibility. In fact, it is the trading opportunity with the least barrier to entry today, especially with the existence of CFDs. CFDs is the regular forex that most people trade today. So yeah, it does carry a lot of liquidity. It's very easy to access. Very little money you can start trading forex. That is a That's a give and take anyways. It's not really all good that the barrier to entry is good. Is low, but that's what it is. So what we try to do with online forex trading, so in simple terms, what we try to do is to buy a currency. We believe that its value is going to rise and then sell it later on in the future. It's something is currently $10 and you anticipate its price to get to $50. It's common sense to just try to buy as much as you can and then sell when the price has increased. So again, it's the inverse is also true. So sell a currency when we believe its value is going to fall, then buy it back at a cheaper price. So if you hold gold or if you have anything of value that you assume that look, its price is going to fall in the next year, there's always somebody who's ready to buy. So it could make sense to sell it now and then buy it back later. So that's also how I will make money. So an example here is if you buy 1,000 US dollars with Naira when it was trading at 500 Naira per dollar, that will cost you 500,000 Naira. Now imagine over the course of the month and the CBN devalues the Naira and it now exchanges at 800 Naira. So your $1,000, the value of the dollar remains the same, is now worth 800,000 Naira. And you just made 300,000 Naira just by buying low and holding. So and this is why I say at the end of the day it's still investing because I think that's the thing, that's another side of it that people do not understand. Trading is still investing, it's just the duration is extremely short. Investing is putting your money in something you assume its price is going to go up, its value is going to increase. That's what investing is. Whether you do it in 10 seconds or you do it in 50 years, investing is investing. But when you do it in a very short period of time, which is less than 3 months, anything less than 3 months, any from 3 months down to 10 seconds, that's trading, really. So 3 months up, we call them swing traders, position traders. So I think anything more than 3 months, it's now reasonable as an investment. It's longer than 3 months, it's going to 6 months, a year. So yeah, so you just made it 300,000 naira just by purchasing a currency that you assumed will increase in value, which it did, and that's the idea. So the idea is not to predict perfectly. Nobody actually can. You cannot know 100% how prices will behave because it could go to 800 naira per dollar and then come back to 650. And your plan is not to predict perfectly. Nobody can do that. Your plan is to respond wisely to price movement based on analysis, discipline, and risk management. We will explain what all of this means. And analysis. So you have an idea. You see the news. Trump is the president today, 2025 November. So Trump is making tweets or Truth Social saying something, and you have an idea that this is going to impact the dollar in this way. It could make sense to just purchase the dollar in that regard. So that's how that works. You do your analysis. So discipline is such that when you do your analysis, you have the guts to take a trade, you have the guts to buy it, and when you buy it, you have the guts to hold for the duration in which you assume that the value of the currency will go higher. The value of the currency may drop initially, and would you be able to hold it through? Would you be able to see it through into profits? So that's what discipline is all about. Would you be there to buy when it's time for you to buy? So there's so many criteria and so many obligations that a trader does have. And then risk management, certainly because you have your analysis, no one is expecting that you put your entire life savings in one trade or in one investment. So risk management is look, I have 1 million. I assume that the dollar would go up from 500 to 1,000. That's 100%. You're doubling your money. And 1 million is all your net worth, everything you have, or maybe all the money you have, all the disposable income you have. Doesn't make sense to put your million in it. You put an amount that look, what if I was wrong? And we are always wrong. I think that's the thing. The job of a trader is really not to be right. The job of a trader is to, when you are wrong, you don't get hurt. That's really what it's all about. The job of a trader is to lose wisely, such that whenever you're wrong, you're not getting massively hurt. And you may ask how this makes sense. Well, because of how something like leverage works, when you are right, you tend to be right properly, and this is how you make money. So the idea is not really to make exponential funds, it's not to make exponential income. It's to ensure that you don't lose too much, so at least you have the opportunity to buy again and invest again. So that's what it's all about, and that's what we try to do. trying to buy a currency when it's low, or an asset. It could be anything. Buy something when the value is cheap and sell it when it's higher. So this brings us to a landing on this lecture. So we've touched what Forex is and the basic idea of how we try to make money trading. It's by buying low and selling high and be buying what you sold at a lower price and making profit from the difference, which we explain what basically what an economic calendar is all about, the flexibility of Forex trading, the time that it's open during the week, the trading volume, the average trading volume of the Forex market per day, and its comparison to the stock market, and some basic terms of trading and the market and Forex markets in general. So this brings us to a good landing. If you have any questions, show them to me. I'm more than willing to answer them. If you have any ideas as well, send them across. And I think this brings us to a good landing. So on to the next lecture. I wish you all peace and good luck.